The Credo multi-asset portfolios invest in third-party passive and active funds across all asset classes. We have 4 portfolios available depending on your risk profile: cautious, moderate, growth or adventurous, each available in sterling and dollars. The overall objective of the portfolios is to preserve capital when things aren't so good and to participate in the upside when the markets are maybe a bit more upbeat. For inclusion in the multi-asset portfolios, a fund has to go through Credo's due diligence process, which includes quantitative and qualitative analysis. On the quant side, we look at returns and portfolio holdings data to determine not just whether a fund has outperformed, but how it's done so. For example, are they outperforming with a number of different positions, or has it been from one lucky trade? Is the outperformance across a whole market cycle, or do they only outperform in certain market environments? And are they promising daily liquidity to their investors, and yet their portfolio is full of illiquid investments? This part of the process is really to determine not just what a fund should be doing, but whether they're actually doing it. The qualitative elements to fund analysis include making sure that a fund's investment process has been consistent over time. Have the human and intellectual capital that were responsible for past investment decisions changed? After all, you wouldn't want to be invested in a fund in which the portfolio manager or the team which are responsible for all the past outperformance have now left. The key questions we're trying to answer through our whole process are whether a fund's outperformance is likely to be repeatable in the future, and whether it's a current fit for our portfolios as they stand. The saying asset allocation is sometimes a bit misunderstood. At Credo, we're not trying to tell you where the FTSE is going to be tomorrow morning. I think the saying goes that if someone tells you they know where the market's going, they're either a liar or an idiot, or perhaps some linear combination of the two. For us, if the fund selection process is the bottom-up part of the analysis, then our asset allocation overlay is the top-down. How does it all fit together? The overlay is to ensure that we're not overly vulnerable to volatility in any one asset class, and we're being compensated for the risk that we're taking. The key word here is diversification, not just by asset class, but also to make sure that at a portfolio level, we're not overexposed to one risk factor, such as interest rate risk, for example. I think it's important to remember that in this day and age, just mixing equities and fixed income from different regions doesn't necessarily protect you, as the macro environment can change overnight. I'm sure that everyone is as sick as I am of hearing about the Eurozone crisis by now, and we all know the facts. They seem to have their own cycle over there, in which a crisis leads to a policy response, then some improvement, and ultimately complacency, which leads to another crisis. I don't have a particularly strong view, but I would say that one thing is still clear: the system can't exist as it does currently. They either need more integration or disintegration, and if politicians don't decide soon on which one they prefer, then I wouldn't be surprised if the ECB has to get out the bazooka again before the end of the year. Well, Japan invented quantitative easing in the early 2000s in an unsuccessful attempt to end deflation over there. And ironically, it's them leading the charge again with money printing this time. I think it was Einstein who once said that the definition of insanity is to do the same thing over and over again and expect a different result. But they do seem a lot more serious this time round, with a particular emphasis on the currency devaluation aspect of their program. Is this time different? Well, there are people much smarter than me who actually think it could be. But I would say that you can only beggar thy neighbour for so long before they start to beggar you back. Look, central banks themselves don't know whether this gamble they're taking on QE is going to land on red or black. So what chance do we have? I think we need to remember that our current fiat money system has only been in existence for 40 years, since President Nixon closed the gold window in 1971. And we're getting more and more experimental by the day. My humble advice would be that whatever happens, don't listen to forecasts, because the global economy truly is in uncharted territory at the moment. And also, don't paint yourself into a corner, because in this period of uncertainty, diversification is more important than it's ever been.